This video is an overview of the break-even analysis. We introduce target net income, and we cover lastly the margin of safety. Now, break-even analysis is a very useful technique for managers in determining the level of production or the required or desired level of sales. This type of analysis involves a calculation of that break-even point in sales. We do it either by units or by total sales dollars. Simply put, the break-even point is calculated by dividing the total fixed costs of the company or operations by the contribution margin per unit to determine the number of units the company must sell to break even. Or we divide the fixed cost by the contribution margin ratio, and that gives us the total sales in dollars to break even. Break even is zero profit. Now, companies want to know how much they have to sell to earn a certain net income. And that is known as target net income. And target net income is the profit goal that a manager sets. Because management not only wants to know how much they have to sell to cover all their costs and break even, but they want to know how much they have to sell to earn a certain profit. To calculate that amount of sales, to achieve a target net income, we simply add the target net income to fixed costs and divide through by the contribution margin per unit if I want the answer in units, or the contribution margin ratio if I want the answer in sales dollars. Next, there is the concept called margin of safety. The margin of safety refers to the difference between the actual sales a company is doing now or expects to do and the amount of sales they need to do to break even. Managers now can utilize the margin of safety to determine how much sales can decline or decrease before the company is no longer profitable. To compute it, we divide the margin of safety in dollars by the actual or expected sale. However, most often, the margin of safety is expressed as a ratio. That is, sales can fall 33% before the company is down to its break-even level. Their margin of safety is 33%. Break-even analysis, determining the target net income, and the margin of safety are all management techniques that we will cover. And this concludes the short overview of break-even analysis. All of this analysis is made possible by our understanding of the cost behavior and the development of the contribution margin.